Smart investors are diversified investors, right? First, if you put all your money in one stock, or all your eggs in one basket, and that one stock tanks, well, then you lose more than everybody else, or even everybody else in that sector. And second, if you are diversified, then you don't have to be right every single time.
But the investment professionals think they're helping you by arranging a diversification. An idiot could diversify a portfolio.
Sure, some will do worse, and some will do better. But sector diversification is the routine, everyday advice we get for investing today. From the modern portfolio theory to robo-investing that most retirement accounts use that we have through our employers. But is diversification the right advice? And what counts as diversification anyway? And is there such a thing as over-diversification? Well, tap the like button and let's find out. According to the Global Industry Classification Standard, aka GICS, the index used to segment 24 industry groups, 69 different industries, and 158 sub-industries, and the tens of thousands of individual companies we might have access to through publicly traded markets, there are 11 different sectors. The sectors are energy, like Exxon and Kinder Morgan, materials, like mining companies, industrials, Boeing, FedEx, consumer discretionary, Starbucks and Amazon. By the way, who really thinks that Starbucks and Amazon are discretionary? They seem more like necessities to most of us. Consumer staples like Procter & Gamble, healthcare, think Johnson & Johnson, financials, JP Morgan or Wells Fargo, information technology, Microsoft, Intel, communication services like Netflix and AT&T, utilities like Duke Energy or Southern Company, and real estate, REITs, real estate investment trusts like my favorite, Simon Property Group. So how do the big indexes use this kind of sector breakdown? Well, it turns out any way they please. You'd think it was 100% divided by 11, but heck no, that would be too easy. It's weighted to reflect how certain sectors contribute to the economy and the relative market cap of each of the companies. So here's the latest, greatest breakdown as of Q1 of 2021 for the S&P 500. Information technology is 27.4%, healthcare is 13%, financials 11.2%, all the way down to materials at 2.6%, utilities at 2.5%, and real estate at just 2.4% of the S&P 500. Now, if we want a diversified portfolio, what will that look like? Well, for most of us, it will mean picking an ETF, an exchange-traded fund that tracks the performance of an index.
The idea of diversification makes sense to a point. If you don't know what you're doing and you want the standard result and not be embarrassed, well, of course, you can widely diversify.
The S&P or Russell indexes are common, and some people overly complicate it and they start choosing an ETF for each of the individual sectors. But according to most, the magic number for diversification tops out at 20. That's when you reach critical mass, and diversifying beyond 20 companies in different sectors really yields no significant return, and it guarantees underperformance. That is, owning more than 20 stocks, even owning up to 1,000, will not give a significant benefit to our portfolios.
But the whole trick of the game is to have a few times when you know that something is better than average, and invest only where you have that extra knowledge.
But all that means is we're not diversified, we're diworsified. And no, I did not make up that word. Even though it sounds like me, I did not make up that word. I promise you. And who is this curmudgeon named Charlie Munger, and why should we care? Charlie Munger is vice chairman of Berkshire Hathaway, Warren Buffett's longtime partner, and he's as old as dirt and as successful as Midas.
Diversification is a protection against ignorance. I mean, if you want to make sure that nothing bad happens to you relative to the market, you own everything. There's nothing wrong with that. I mean, that is a perfectly sound approach for somebody who does not feel they know how to analyze businesses.
Yeah, what he's saying is that much of what is taught in modern corporate finance courses is twaddle.
So, too diverse? Not diverse enough? What do we find out what's right?
But three wonderful businesses is more than It's more than you need in this life to do very well. And the average person isn't going to run into that. I mean, if you look at how the fortunes were built in this country, they weren't built out of a portfolio of 50 companies. They were built by someone who identified with a wonderful business. Coca-Cola is a great example. A lot of fortunes have been built on that. And there aren't 50 Coca-Colas.
See, Charlie and Warren are not fans of the modern portfolio theory, but it seems like everyone else is. The solution to this diversification problem for most of us is that we're advised to go out and hire a professional. Now, I'm not a financial professional. This isn't financial advice. This is for educational purposes only. But the one thing that hiring a professional guarantees is that it will not get simpler.
You cannot believe this stuff. I mean, it's modern portfolio theory, and
it has no utility. I mean, it will tell you how to do average, but I think anybody can figure out how to do average in 5th grade. I mean, it's just not that difficult, and it's elaborate, and there's lots of little Greek letters and all kinds of things to make you feel that you're in the big leagues.
And the temptation that we have to play this routine game of diversification might be just a guarantee that we will never outperform the market. Did you know that when you buy an index fund, any index fund, you are already paying a professional? Each index fund includes a fractional percentage called an expense ratio. So one fund I'm in, SPHD, or the Invesco S&P 500 High Dividend Low Volatility ETF, has a 0.03% or $3 expense on every $1,000 invested. The things we buy, especially ETFs on the market, are tampered down. They're meant to manage volatility, not to grant us a significant upside. They're stable, they're safe, they're products that are created and regulated according to a risk appetite that tells us you can't afford too much risk. You will never see too much upside. So take a look at what you actually own today and ask yourself these 3 questions. First of all, do you really know what you own?
I think that we should see 1/4 of that, and that is 1/5 of the total revenue from all of last year. Excellent, Paul. Well done, Paul. Thank you. Any questions? No.
Not for me.
Yes? Yes?
I don't get it.
But after I know what I own, I have to discover whether or not it's worth owning. The price to earnings ratio is a good place to start, and then compare that to others in the same sector. You'll find that growth stocks, even and especially those that don't yet make a profit, will have a high PE ratio, while value companies, dividend-yielding dinosaurs, are much lower. So we need to compare apples to apples. And our third question to ask is about time and timing, because the longer we own something, the more upside there is to owning it. The returns on that are greater than jumping in and out of hot news-driven cycles. Or as the old adage goes, time in the market beats timing the market. And there's this strange truism in finance that the longer we own something, the less expensive it is for us to own it. Not just because of dividends and price appreciation, but also psychologically. The longer we own something, the less expensive it is to us. Oh, and one more thing about this timing thing. If the money that we have that we're thinking about using is something that we need for food or rent or to pay bills next month, then it's probably not money we should invest. If we need to access it in 3 hours, 3 days, 3 weeks, or even 3 months, it's really not investment money. It's money that we should be living on. And if we do try to invest that money, it will quickly turn into a trade, and most of those trades we end up selling at a loss. This diversification thing can be overly complicated, and we can even pay people to make it even more complicated. So the alternative to that is asking, do I know what I own? Do I know if it's worth owning? And how much time am I willing to give it to pay me, to go to work for me? Because it's better to have money working for you than you just be working for money. Hey, and I hope this has helped you figure out not only where your money is, but maybe where there are gaping holes, Grand Canyon-sized holes in what you've got invested. And if you've benefited in any way, please tap the like button because it really helps. And while you're down there, how about subscribe and ring the notifications bell so you don't miss any episodes of The Do-Over Show every Monday and Friday. I'm glad you found me, and I found you. Thanks.
If you find 3 wonderful businesses in your life, you'll get very rich.